Hello, good people. My name is CPA Edwin OCHOI. So this is just an exclusive channel for e-learning. And at the same time, I will be bringing advisory matters from next month. So I'll be talking about financial management, practical aspect on how you're supposed to manage your finances and other things. So, but for now, I have been dealing with just CPA, to be more specific, financial reporting and advanced financial reporting, of which again I will be moving to financial accounting and some of other units in the coming days. So welcome. So for today, my area of concern is branch accounting. So this branch accounting is under, that is a financial reporting section 3. So that is according to the CASNEP syllabus. So this is all about for accountants. So to be specific, branch accounting. So when we talk about branch accounting, it's whereby now you find that we have an organization, it has an head office in a certain area, let's say Nairobi. Then it could like to extend its business to another geographical area. So remember that it has to open a branch. It can attempt to open a branch within Kenya, or it can move out outside Kenya and open another branch in a foreign area. So it's all about how, so branch accounting, it's all about when the business wants to expand its geographical area of operation. So whereby it opens a branch in a different area. So when we talk about branch accounting, we have, according to the now CASNEP syllabus, we have independent branches and we have dependent branches. So independent and dependent. So under the independent, we have local independent branches. That is under independent. I've said we have local independence. So local independence is whereby you find that the branch maintains its own books of accounts, and the branch itself is in the same geographical area with the parent. So if the head office, not the parent, if the head office is in Nairobi, it has opened a branch in Mombasa. So you can see the head office and the branch, they are in the same area, that is in Kenya. So local independent branches. Then on the part of independent, we can have a foreign independent branch. Foreign independent branch. So for the foreign independent branch, you will find that the head office will go ahead to open another branch in a different area. That is, let's say now Uganda. If the parent, if the head office, to be specific, if the head office was in Kenya. So we can go ahead and look on some of the notes I have prepared so that you understand what we talk about branch accounting in depth. So let me share some of the notes which we have to go through as I explain, so that you will be able to understand what I mean. So this is all about the notes I prepared for you guys, and they are well summarized. So we say that a branch is an extension of a business to different geographical area in order to meet customer satisfaction. Like now, the way I've said, if the head office was in Nairobi, they can open another branch in Mombasa. So they have just extended their area of operation. So they can be able at the same time to serve the customers in Mombasa. Or they can even move outside Kenya. So if the head office was in Nairobi, Kenya, they can now move to the United States of America. So that is all about now they have extended their geographical area. So reasons, or we have advantages of branch accounting. Why now do we carry out branch accounting? So what are some of these advantages at the same time? So for the advantage or the reasons, we say that to ensure proper control on branches. So obvious, for the head office to control the operations of the branch, it has to do the relevant accounting concerning branch accounting. So mostly you will find that the head office will maintain a current account known as branch current account. And for the branch to report to the head office, the branch will prepare an end office current account. The number 2, to safeguard cash and inventory of goods in the branches. That is a direct point. To compare the profitability of different branches. So if you have many branches, obviously you have to do the relevant accounting in order to compare their profitability. To evaluate the trends and prospects of the branches. So what about their own concern? How are they performing? So you have to do the relevant accounting. That is to be specific branch accounting. Then we have types of branches. I have said we have dependent branches, or they call it non-autonomous, and we have independent branches. So to start with, that is dependent branches. So these are branches which are controlled by the head office. So the branch are controlled by the head office. So unlike the independent now, the independent, you will find that the branch, they are independent on their own. So characteristics of dependent branches, they do not maintain their own books of accounts. So as we have said from the definition, that they are controlled by the head office. All goods are sent from the head office. So the goods, the branch, they receive from the head office. Number 3, all cash sales to be remitted to the head office on daily basis. So obviously the branch must remit cash sales to the head office. So any petty cash expenditure must be authorized by the head office. That is the point you understand. So the head office should maintain the following books in order to check the operations of the dependent branch. So which are these books which must be maintained? Number 1, we have branch inventory account. So for the branch inventory account, it records the movement of inventory from the head office. So it's always maintained at invoice price. And invoice price, you know that it's all about the cost of inventory. You add the markup. Then once you prepare your inventory account, the balancing figure in this account represents cost of goods sold. Then another account we prepare is all about goods sent to branch account. So for the goods sent to branch, it's all about the records or the goods sent to the branch by the head office. So goods sent to branch account. So record all goods sent to the branch by the head office. So all the goods which the branch received by the head office, that is, they are recorded under the goods sent to the branch account. It's maintained at cost. Remember that the first one we said it's maintained at invoice price, which is the cost of inventory plus the markup. That is the invoice price. Then the account of goods sent to branch, it's maintained at cost. Then branch markup account, or we call it adjustment account, records profit on the inventory held by the branch. So the balancing figure represents gross profit margin realized. Then we have branch receivables or debtors account, record all credit sales, and debtors balance. The balancing figure represents credit sales. Then we have a branch cash account, record all cash transactions by the branch. So the balancing figure represents cash sales. So now, for the independent, it's a very easy question you could find in your exam, because what you need to understand is all about the accounting entries you are supposed to make. Like now, with goods sent to branch, from where? From the head office, you debit your branch stock account at selling price, because obviously you have to increase the stock account, the inventory account, because you have received goods. So when you debit the stock account, the account, you have increased the account. Then you credit goods sent to branch at cost price. Then you credit branch markup with the profit loading. So that is the entries you make. And once you understand these entries, for the question of independent, it will be easy for you. So with goods returned by the branch to the head office, so with goods returns by the branch to the head office, so you debit goods sent to branch at cost price, debit branch markup with profit loading, credit branch stock at selling price. Then we have when goods are sold by the branch, either on cash or credit. Obviously, they have to debit cash. If it was on credit, they have to debit the debtors account. Then remember that they have sold stock, so they credit branch stock. So with cash received from debtors, so this is just a normal entry, which you know in any books of accounts. Once you receive cash, debit cash account, credit debtors account. So if you receive a discount or you are around, so discount around to debtors. So you are around discount when you are selling goods. So you debit discount around, credit debtors account. So with bad debt written off, you debit the bad debts account, then you credit your debtors. Because obvious bad debts, remember that it's something which you have been requisitioning concerning the amount your customers owes you. You have been trying to get the amount to be paid, but now it's in vain. So you cannot be able to recover. So you have to write off. That's why you can see we are reducing our debtors account by subtracting. That is by crediting. Then we debit bad debts account. So with goods returns by the debtors to the branch. So if the debtors returns goods to the branch, so you debit branch stock, because obviously now they would come to the stock, and you reduce the debtors, that is you credit debtors account. So the next, with goods returns by the debtors directly by debt, that is with goods returns by debtors directly to the head office, directly to the head office. So it's supposed to be that way. So with goods returns by debtors directly to the head office, directly to the head office. What are we supposed to do? So what you are supposed to do on this case is all about alternative one. So on this scenario, goods returned by debtors directly to the head office. So what you always do, alternative one, you debit goods sent to the branch. You debit branch markup with the profit loading. Remember the first one was you debit goods sent to branch at cost, debit branch markup with profit loading, credit debtors at selling price. Then then you credit debtors at selling price. Then alternative two, you first assume that the debtors returned the goods to the branch. So you debit branch stock at selling price, credit debtors at selling price, then assume that the branch returns the goods to the head office. So debit goods sent to the branch at cost price, then debit branch markup with the profit loading, then you credit branch stock at selling price. So with any increase in selling price, that is with any markup in price, debit branch stock, credit branch markup. Then with any decrease in selling price, with any markup in price, debit branch markup, credit branch stock. So with normal loss of stock at the branch, you debit branch markup at selling price, you credit branch stock at selling price. Then with abnormal loss of stock, each good stolen, damaged or becoming obsolete, debit branch profit and loss at cost price, then debit branch markup with the profit loading, credit branch stock at selling price. So this is something I will continue. So it's all about understanding the debit and the credit elements. So I cannot be going through all of them because for today, my concern was concerning independent, that is a dependent. So for today, I was concerned to talk about, because we have two of them, we have dependent and we have independent. So I was supposed to talk about independent branches. So for the independent branches, that is whereby you will find that most of the questions will come from. Even if yes, they can test dependent, that is an easy part of the topic because it's just understanding the debit and the credit aspect. So which whoever needs these notes to read and understand the debit and the credit, because once you understand what to debit, what to credit, you can be able to do a question. Because it's just a small question, even if I will do another question next time. So whoever will be in need of the question will be able to just chat with me through 0728 760 546. I will be able to assist you with these notes for dependent, so that without wastage of time, we move to independent. So independent, that is where I would be taking most of my time today. Like now, remember that these are about dependent. You can see even I have tackled some questions for you guys. So it's just more questions, which needs to understand debit and the credit aspect. So we can move to the main part for today. That is independent branches. So for the independent branches, we call them autonomous branches. We have local independent and we have foreign. So this is where I said that when we have local independent, you will find that the head office and the branch, they are independent. But now, to be specific, the local independent is whereby now the head office and the branch, they are in the same country. Then for foreign, you will find that the head office is in a different country, then the branch is in a different country. So to start with the local independent, so these are branches which maintain their own sets of financial statements and books of accounts, which you know, even from the meaning of the word independent. So, however, the head office plays an oversight role, even if the branch is independent. That is, to verify the operations of the independent branch. So now, in order now the head office to carry out the role of oversight, obvious, it must maintain a certain account. And I mentioned it earlier enough, which is called head office current account. So that is why we have said that to verify the operations of the independent branch, the head office will maintain account known as branch current account. So that is fine. So the head office will obviously maintain branch current account. Then the branch will maintain head office. Then similarly, the branch should also maintain an account known as head office current account. That is fine. So these are the relevant accounts. So the branch current account, which is maintained by the head office. So this account is maintained by the office to record the transactions between the head office and the branch. So you can see what you are supposed to do there, of which I will do it later in the question. So with the balance in the branch current account represents the head office investment in the branch. So the balance in the branch current account represents the head office's investment in the branch. That is why obvious when I will be doing my statement of financial position, remember that for you to prepare the statement of financial position, the head office will prepare an independent statement, the branch will prepare an independent statement, then the head office will prepare a combined one for both the head office and the branch. So this element of branch current account will be recorded as a non-current asset under the statement, that is the statement of financial position of the head office. So you can see they have said it's treated as an investment. So when I will be recording the branch current account under the column of the head office as a non-current asset, this is the reason why, because it's treated as an investment. So then this is the head office current account, of which we have said the head office current account is maintained by the branch. So what about the balancing figure in that account? The balancing figure in head office current account represents operating capital. And remember that this one would be recorded as what? So it represents operating capital to the branch, and therefore shown as an equity component, in the books of the branch. So the balance in the branch current account should be equal and opposite to the balances in the head office current account. However, there are circumstances when these two balances may not be equal. So when you are preparing the two accounts, so the head office, which is maintained by the branch, and the branch current account, which is maintained by the head office. So the two accounts are supposed to be equal and opposite to each other. So, but we have some scenarios whereby they might not be equal. So what is the cause of them not being equal and opposite to each other? So in a scenario where there are cash in transit, where there is goods in transit, when there is inter-branch transfer. So those are the three aspects. Then we have the concept of unrealized profit. So when we talk about unrealized profit, you will find that in some scenarios, the stock of the branch is the one which it received from the head office at a cost plus a profit. So when the head office was selling goods to the branch, it sold at a profit. But now by the end of the year, you will realize that this stock, some of it, it's remaining in the stock of this branch. So since it received this stock from the head office and it was at a profit, and by the end of the year, the branch has not resold all the stock it received from this head office, it means that it has not realized the entire profit. So that is why we have to check for the unrealized profit in the stock of the branch. So we have said it arises when goods sent to branch at a profit remain unsold at the end of the financial period. So this implies that profit on goods remained unrealized and it should be eliminated. So we have to check that unrealized profit. We eliminate it under the profit of the head office, because now the head office profit would be overstated by what the branch never realized, because the branch never resold all the goods it received from this head office. So which means that the head office, not the head office, the head office profit is more, it's overstated, because the branch never resold all the goods it received from that head office, and at the same time it received at a profit. So then we have preparations of financial statements, that is final financial statements. So the head office and the independent branch will prepare their own independent financial statements. However, at the end of the year, the head office should prepare combined financial statements. So the head office and the branch, the head office and the independent branch will prepare their own financial statement. Then you will find that the head office will prepare a combined. That is why you can see my format here. We have the column of the head office, we have the column of the branch, and the combined. So we always start from sales. So sales will be appearing head office under branch, combined. Goods sent to branch. So goods sent to branch, you will only record under the head office. So this GSTB means goods sent to branch. So that if you can see down here under after purchases, there is something we have said as, which is stated as GFHO, goods from head office. So these goods which we have recorded up here, GSTB, goods sent to the branch, they are the one which is received down here as goods from head office. That is why you can see I have recorded it under the branch. So these goods from head office under the branch after the purchases here is supposed to be the same with goods sent to branch. So the two are supposed to be equal. So if they are not equal, maybe you will find that there was an element of goods in transit which have not been received by the branch. Then we have res goods stored in transit to branch. You reduce your head office because the head office is the one which was sending. Then you get net sales. You talk about cost of sales, opening inventory, purchases. Then I have explained about this GFHO, that is goods from head office. Then we have to reduce if there was some obsolete goods and destroyed goods. So it can be at the head office and the branch, so that you get the cost of goods available for sale. You raise closing inventory so that you get the cost of sales. So in order to get the gross profit, you have to check your net sales, which I named A. Then you have to do what? To raise your cost of sales. So to get a gross profit. Then you have to raise expenses by starting with and realize the profit, which I've already explained, because you will find that the profit of this head office is more. So it's overstated by what the branch never realized, because you will find that the branch never resold all the goods it received from this head office. So we have to check the unrealized profit on the stock of the branch, but we reduce under the head office because now the head office is the one which sold to the branch and their profit is more by that profit element which the branch never realized out of that stock. Then we have administrative expense, we have distribution, you get net profit. Then after getting net profit, obvious, the branch must transfer its profit. So transfer branch profit to head office. So this profit you get under the branch will be transferred to the head office. So you get the retained earnings for the year. Then for the statement of financial position is just a normal thing. So non-current assets, you start with what you are given. So there will be more assets maybe. So this is just a sample. So we have property, plant, and equipment. Then I just explained some minutes ago why the branch current account would be recorded under the head office, because it's treated as an investment. But we have to reduce the net. We have to reduce, that is unrealized profit. That is why we have written net of unrealized profit. The same explanation applies why we are subtracting unrealized profit under the branch current account, because you know branch current account is maintained by who? Head office. And the head office is the one which sold goods to the branch. But the branch never resold all the goods. So you check for the unrealized profit and it has to be subtracted there when you are recording your branch current account. Then for inventory, receivables, bank balance, cash in transit, that is direct. Ordinary share capital, retained earnings, then you have to record their head office current account. That is fine. Then current liabilities, you can go with payables. So the main concern is on how to value closing inventory. So to understand this more, I will just illustrate in a question. But again, it's there, you can see that is the relevant formula. So when we'll be doing a question, you will be able to understand more that formula. Then the branch closing inventory should be valued at invoice price. Again, that is how you do. So this is how you value inventory for 3 aspects. So for the head office, for the branch, and for the combined. And for the combined. So that is why I was saying that maybe you might be in request of these notes to go through, but at the same time you will understand, because I will be doing a question which will cover everything you have to understand. But if you need the question, these notes, call me. That is my number. That is my relevant contact, Edwin OCHOI. So So 28,765.46. Now let us go to the question so that we can be able to understand this element of independent branches starting with local independent branches, starting with local independent. So let us start with a question of 2014. So I'll be sharing on the other side. I will be sharing on the other side. So it will be coming up shortly. So there we go. There we go. So that is the question. So I have to check again. So because so we go, that is the question. So the question is for May 2014, question 3. So they say Moshi Enterprises commenced business on 1st April 2013. Head office of the firm is in Nairobi with a branch in Mombasa. So the branch is managed by a salaried manager. So Moshi Enterprises acquire job products or plastic toys and package them according to customer order. So the packaging is a feature of the firm's marketing strategy. And the cost 10% of the cost price of the toys. The toys are therefore sold at a profit of 12% of the selling price. Package toys are sent to Mombasa branch at a selling price less 6%. So the main thing is understanding about these percentages. At the same time, understanding if this equation is of local independent or foreign, or is dependent. But on this scenario, you can see they said Moshi Enterprises commenced business on 1st April 2013. Head office of the firm is Nairobi with a branch in Mombasa. So you can see that at the same time, the head office and the branches are in Kenya. They are in the same area. So whereby the branch is managed by a salaried manager, which means that the branch is independent and it's a local independent. So Moshi Enterprises acquire job products of plastic toys and package them according to customer order. Packaging is a feature of the firm's marketing strategy and the cost 10% of the cost price of the toys. So the packaging is a feature of the marketing strategy. So for marketing, we are not concerned. So what I'm concerned with is getting the percentages at which the head office is transferring the goods to the branch, or the way the head office was selling. No, anyway, it was not even transferring, it was selling. Then at the same time, the percentage at which the branch and the head office were making sales, maybe to third parties, at what profit. So that is what we have to determine first. So I can go direct and start my question without wastage of time. We determine those percentages, the two of them. The way they were transferring, head office was transferring goods to branch, that is the way it was selling goods to the branch, and the way the head office and the branch were making sales, at what percentage. So we have this last sentence here, they have said, the last two sentences to be specific, they have said, the toys are therefore sold at a profit of 12% of the selling price. The toys are therefore sold at a profit of 12% of the selling price. That implies that that is the percentage, that is the profit margin at which they were making sales of the toys. So packaged toys are sent to Mombasa branch at a selling price less 6%. So we can do this. So we know that selling price, we know that selling price will be So our selling price will be, we have to check about the cost plus the relevant profit. So the way they were making sales and the way in which the head office, when I say HO, I mean head office transfer, or we call sell to branch. So when they say that 12% and 6%, we need to check which affect sales, which affect the way the head office was selling goods to branch. So the first 12% was concerning the sales, because they have said the toys are therefore sold at 12% of the selling price. And when they say at selling price, know that obviously your selling price would be at 100%. If they could have said that 12% at cost, I could have said that my price to start with would be at 112. So I have to raise by adding the 12. So for now, my selling price, because it's in margin, it's not in markup. When they say at markup is when you add, so I could have said 100 plus 12 to get 112. But for now, it's on selling price. So my selling price would be at 100%. Obvious. My selling price would be at 100%. So that the profit you are told is the one which is 12%. And we know that now to get the cost, you just take 100 minus 12. So which I'm getting 88%. So that is the relevant percentages concerning sales. Then the next thing is concerning the way the head office was selling goods to the branch. It was at selling price less 12%, 12 or 6, it was 6%. So they said, packaged toys, there are sentence, packaged toys are sent to Mombasa branch at a selling price less 6%. Packaged toys are sent to Mombasa branch at a selling price less 6%. And we have said that our selling price, if it's selling price, because that is margin, will be obvious at 100, less 6%. So if we take 100 minus 6, we will get 94. So this one will be 94%. So that the relevant profit here is 6%. So that to get the cost, you take 94 minus 6, which is 88%. So you get the 88%. So those are the first percentages you have to determine. So I said if it could have been on cost, I could have said this one could be 112. Then at the same time here, it could have been 12, then this is 100%. So anyway, you understand what I'm saying. So we will be doing another question next time whereby they say at cost, not at selling price. So for now, at selling price, your selling price would be at 100%, then the profit you are given, then to get the cost, you take 100 minus 12, the same with head office to branch. So you do that way, the way I've explained. So we continue with the interpretation of the question. And that is how you start the question. So without determining those percentages, you will not be able to do this question. You will just score some marks, but not good marks. So you need to know how to determine those percentages. So you are given a trial balance there. You can see for head office, for branch. So I don't have to read the transactions in the head office and the branch. You know it's all about assets, liabilities, expenses, incomes. So all of those items. Additional information. Packaged goods, whose selling price to public was shillings 30,809, were dispatched by the head office to Mombasa branch on 28 March 2014, and they were received on 5th April 2015. So you can see we have some goods which were being sold to the public of 30,809, but now they were being dispatched by the head office to Mombasa branch on 28, but they were received on 5th April. What you can see, our financial year ends 31st March. You can see even from the required, you are required to prepare your statement as at 31st March 2014. That is the time when our financial year was ending. But now these goods which were being transferred, being dispatched by the head office to branch, were received on 5th April, which means that is after the financial year has ended. So which means by the end of the financial year, these goods were on transit. That is how you say that. Note 1 concerns goods on transit. Note 2, Mombasa branch sent cash amounting to 50,000 to the head office on 5th, not on 5th, on 30th March 2014. The cash was not received until 6th April 2014. So Mombasa branch had sent some of the amount of 50,000 to head office on the correct date, but now these were received on a later date after we have closed the financial year. So which means that by the end of the financial year, they were on transit. The goods were on transit. Not the goods, but the cash. The first one was concerning goods. The second one now is cash in transit. By the end of the year, the cash was in transit. It has not been received by the intended party, which is the head office. Number 3, annual stock take on 31st March 2014 revealed the following. It reveals that toys which cost the head office 10,000 were considered obsolete. Packaging materials at the head office which cost 5,000 was spoiled. Mombasa branch stock take revealed a stock shortage of shillings 13,000 being invoice priced by the head office to the branch. Number 4, provision is to be made to the Mombasa branch manager at 10% of the net profit after the bonus. Fixtures are to be depreciated at 20% per annum on straight line basis. That is fine. So you are required to do Moshi Enterprises head office, branch, and a combined income statements, and the same for the statement of financial position. So we can go direct and start the question from the income statement. And I think you know the format very well. The one which is I shared early enough. And I already have interpreted about the percentages. They are very important. So I will start with the income statement. I will say Moshi Enterprises. So we have an income statement. So it's for the year. So it was for the year ended which period? It was ending on, I think March, December. So let me check in my past paper. So it was 31st March 2014. So 31st March 2014. So remember that the head office will prepare its own statement. The branch will do the same. And we have for the combined. We have for the combined. So the transactions of the head office will be maintained at cost. This one is at invoice price. Invoice price, which means at cost plus profit. That is invoice price. Then this one is at cost. So then here we have to start from sales. So for sales, we have 2.8 and 1.5. And these are coming from the trial balance. So which when you will be going through the question, try to be following your past paper. If you don't have the past paper, I can also assist you. Talk with me, you have my number, the one I shared. So that when you will be following, you follow with the past paper. So on this scenario anyway, I will display some items. So we have sales. Sales is here. For the head office is 2.8 and for the branch is 1.5. That is direct. So then for the combined, you take 2.8 plus this one, that is 4.3. Then after that, you talk about goods sent to branch. So goods sent to branch, again, is from the trial balance. So we have only one thing which we will dispute with. There is something here which I know you might dispute with, because I said that. So for goods sent to branch, we have, you can see we have 1,000. So you can see goods sent to branch. 1,000, that is 1 million, not 1,000. 1,598,000. But now under the column of the branch, this is the side of the branch received 1,569,040. So the head office sent more goods of 1.598, but the branch received 1.69. So where is the difference? Because the goods with the head office sent are the one with the branch is supposed to receive. So why is this a difference coming from? So there's a deviation. There's a deviation. If I can use my calc, there's a deviation of if I take 1598,000, that is 1,598,000 minus 1,569,004. So I'm getting 28,960. So there's a difference of 28,960. So where is this 28,960? So we said if the two are not equal in this scenario, maybe there's goods which the head office had sent, but by the end of the period, they have not been received by the branch. Like now, if you go to note 1, we have some packaged goods whose selling price to the public. First, you have to determine where was these goods coming from. So these are the goods which were being sold to the public of 30,809. So they are being dispatched by the head office to the branch. But instead of being received by the end of the year, they were received on 5th April, which is after the end of the year. So even if this 3809 is not the same as the 28,960, we can determine how we are getting this 28,960, because these goods of 3809, they were being sold to the public. And we know that goods sold to the public, they are sold at a percentage of 100%. That is why I talked about these percentages. So the sales are made at any sale. The sales I said can be to third parties at 100%. So these goods of 3809, they were being sold to the public. Then they were being dispatched to the branch. And we know that for the goods to be dispatched to the branch, they are supposed to be dispatched at 94%. So we need to get 94% of those goods. So if I take 94 times 3809, you divide 100. You are supposed to get 28,960. So the difference, that is why the goods sent to the branch and the one with the branch received were not in agreement by 28,960, because some were on transit. So, but now for now, I have to record the total amount of the goods sent to the branch. I have to record the total amount of 1598,000, 1598,000, so that I will be able to get a net sales. So a net sales, if I take the two, I can see here I'm getting 4398, then this is 1.5, then this is 4.3. Then we have to raise cost of sales. So remember the net sales, this is my A. Then for the cost of sales, we have to talk about openings inventory or stock. It's the same thing. So for the equation, there was no opening inventory. There was no opening. Then there was purchases. So I can see there was purchases in two ways. So purchases of packaging materials and purchases of toys from the trial balance. Purchases of packaging materials and purchases of toys. So this one, and they were on the head office. So purchase of packaging material 440,000, purchase of toys 4 million. So that one would be 4,440,000 under the head office. So 4,440,000. So for the branch, there was no any purchases. So I'm getting a 4,440,000 here. So the one which is under the head office. After that, we have to talk about goods from the head office. We have to add now goods from head office. So the one already with the from the trial balance, 1569,040. 1569,040. So 1569,040, these are the one which I'm recording here. So remember that the goods sent to branch, 1598. These are now the one which they received, 1569,040, goods from head office. That is what I have recorded, 1569,040. After that, we have to talk about some of the items which can reduce our purchases or our stock, of which according to this question, there was a stock take which was taken, and it revealed some fishy things which happened, whereby I can see that there was some obsolete goods, spoiled, and some shortage. That is according to note 3. An annual stock take on 31st March revealed the following. So we have to record this. Like now, toys which cost the office 10,000 were considered obsolete. So they are on cost, which is fine. You don't have to adjust anything. You record that 10 under the office and under combined. Packaging materials at the office, which cost 5,000 was spoiled. Then, so let us record that one, because the third one, I know it needs a working. So let's raise some obsolete. So 10,000. Then we have here 10,000. Then again, we have to subtract the spoiled at the head office at a cost of 5,000. And I never forget that the head office is maintained at cost, and this one is fine. They have stated at cost. Then the combined again is at cost, which is fine. After that, we have to raise now the shortage. So the shortage. So the shortage was according to that note 3, and it was on invoice price. So the Mombasa branch, so you can see a note 3, so under the statement 3 there, Mombasa branch stock take revealed a stock shortage of 13,000 being invoice price by the head office to the branch. So for the branch, it's fine. I will record at 13, which is at invoice price, so there's no problem. So it was at invoice price, and we know that goods are sent by the head office to the branch at an invoice price of 94%. So which means that this 13,000 was at 94. And they are correctly stated that they were at the invoice price, which is 94. But you know that for the combined, you have to record those goods at cost. And our cost will be at 88%. So we need to get the 88%. So I have to take 88 times 13,000. I have to divide with 94. That is how I will get the answer there for the cost to record under the final column of the head office. So that one will be, so if I use my calculator, it will be 12,170. It will be 12,170. So this is 12,170. So that is how we have converted those goods which were in invoice price to cost. So up to that point, we are done with the adjustment which we are supposed to make there, so that I will get cost of goods available for sale. Cost of goods available for sale. So the cost of goods available for sale. So cost of goods available for sale, remember I will take my 4 million minus 15,000. So 4 million minus 15,000, that is 44.25. Then the other one would be 15,69,040 minus 13,000, that is 15,56,040. Then the last one will be that is 44.12, 830. So when you will be doing again compute, so that we have to raise inventory. Closing now. We have to raise the closing stock. So once I get the closing stock here, and that is the one which needs a bit of workings, I will be able to get the cost of goods sold. So cost of goods sold. So let us do now the element of closing stock. So the element of closing stock. So when we talk about closing stock, so what you are supposed to do under closing stock, you know that cost of sales is equals to opening stock plus purchases minus closing stock. So that to get now my closing stock, I will make it to be the subject of a formula, so that it will be opening stock plus purchases minus cost of sales minus the cost of sales. So that to start with the head office, and I know that the head office is maintained at cost, which means that my cost, the percentages for cost here would be at 88% from the percentages we did at the start of the question there. So if anything which would be recorded under the head office would be at cost. So we start with opening stock. So opening stock was not there. So this is the column I'm checking on. Purchases. Purchases was 4,440,000 because it was from two areas. Purchase of materials, that is packaging materials, and the purchase of toys. Then again, we have to raise. There was obsolete, and we have some spoiled. So that one we have to subtract. Then again, we have to subtract some goods sent to branch. So let me first raise the obsolete, because the goods, some goods which were obsolete under the head office. Obviously, we have to reduce this stock. Even if it's not appearing in this formula, these are the adjustments I have to make. Obsolete, we raise spoiled, because it's the same stock which was spoiled. Then that is 5,000. Again, remember that we have to raise some goods which you send to the goods sent to branch. Goods sent to branch. So the goods sent to branch were at 1598,000. So the 1598, which you know that goods are sent to the branch at 94%. They were sent at 94. So we need 88%. So what I will do here, I have to take 88 times 15, 98. I have to take 88 times 15, 98. I divide by 94. So that I convert that 1598 because they were goods sent to the branch and they were sent at 94%. That is what we said early enough, those percentages. Goods are transferred to the branch at 94%. Sales are made at 100%, of which sales is later to third parties. So to do that, I'm getting 1496. 1496. Then finally, you have to raise cost of sales. So under cost of sales, we use the sales. So used sales, and the sales, we use the sales, and the sales for the head office is 2.8. So 2.8 sales is at 100%. So we need which percentage? So that one is at 100%, of which we need 88%. So I will take 88 times 2.8 divided by 100. So I'm getting 2464. Oh, that is fine. So if I take 4,440,000 minus 10,000 minus 5 minus 1496 minus 2464, I'm getting 465. So that is 465 for the closing stock of the head office. So 465,000. 465,000. Then we have to take for the branch. So for the branch, we use the same formula. So with the same formula, on this case, we have to check by starting with opening. So this I'm doing for the branch. So which for the branch, remember that it's supposed to be maintained at 94% because goods are sent to the branch at 94. So opening stock is not there. Then we have purchases. So purchases of the branch, we have nothing. You can see even from this column. Then we have goods from head office. That is what it received. So we need to add that one. So that is at least now the stock which it has. Goods from head office. So 1569. So this one, 040. Then after that, remember that we have some shortage of goods, which was 13,000, which was at invoice price, which is fine. It was at 94. Then after that, we have to raise cost of sales. We have to raise the cost of sales. So which sales of the branch is 1.5. That is what I said. Cost of sales, use the sales. So the 1.5. So that one sales is at 100%. So we need 94%. So you take 94 times 1.5 divided by 100%. So if you divide that 94 times 1.5 divided by 100, I'm getting 1410. So that the answer there would be 1569,040 minus 13,000 minus 1410, that is 146,040. So 146,040 is what you record here. So 146,040. Then now finally for the combined, remember for the combined is supposed to be at cost, which means that it's at 88%. For the head office, it's fine. Head office was at cost. So head office, we got 465,000. Then for the branch, remember this for the branch, the 146,040 is at 94%. That one is at 94%. So the 146,040. So we cannot add direct. That is why I'm trying to do this working. So we need to get 88% of this. So we need to get 88. So 88 times 146,040. You divide 94. So that one I am getting what? This one 88 1 times 146 divided by that. I'm getting 136,718. So then finally there's one thing which you need to add under the combined, which was never adjusted under the branch. Under note 1, if you can remember, there was some goods of 30,809, which were being dispatched by the head office to the branch. But these goods were being sold to the public, of which they were never received by the relevant branch by the end of the year. They were received, yes, but on a later date. Note 1, packaged goods whose selling price to the public. So 3809, and the sales we know to the public is at 100%. Were dispatched by the head office to Mombasa branch on 28 March 2014, and were received on 5th April 2014. They were received on 5th April 2014. So yes, they were received by the branch, but on a later date. So we cannot adjust under the branch, but we need to adjust under combined. That is why they will affect my closing stock of the combined. So goods on transit. Because obviously for the combined, it's prepared by the head office and it contains both the transactions of the head office and the branch. So the branch could have not adjusted it because they were received by after that is, not by after that is, after the end of the financial year, so 5th April. So what you do, goods on transit, they were 3809, not so 3809, of which these goods were being first sold to the public. That is what they say. And we know that our sales are made at 100%. So we need to equate those goods with 100%, of which you know that we need which percentage? 88%. We need the 88%. So you know how to do it. You take 88 times 3809, you divide with 100. It's a matter of understanding those percentages. So if I use my calc, I'm getting 27,112. So that I will add 465, 136,718, 27,112. So I'm getting 628, 830. 628, 830. 628, 830. So up to that point, you subtract those items you have as closing stock from the cost of goods available for sale. So if I can do the first one, here I'm getting 3960. The second one is 1410. That is 1,000. Then the last one is 3784. That is 3784. Up to that point, that is fine. So this is now B. That is my B. So I will be looking for gross profit. So I will check my net sales. Like now the first one is 43.98. Then minus this 39.60. I will get a gross profit. The same with this. So to continue, so I have to take the relevant items there, which I've said. Like now the first one, remember here, I will check the first one, this minus this. Then the same with the second one. Then for the combined, to get the gross profit. So if I just do that, like now the first one is 43.98 minus 39.60. So that one I'm getting 438. Then the second one is 90,000. The third one is 516,000. Then now we need to raise expenses. We need to raise expenses. So for expenses, the first expense I will start with is to determine unrealized profit, of which I said unrealized profit, the first thing will be on closing stock of the branch. Because this stock was received from the head office at a profit, but the branch has not resold the entire goods. So which means that the unsold goods, inside that unsold goods, we have some unrealized profit. So this closing stock was, you can see there we have a closing stock of 146,040, this one. This 146,040, so the 146,040 was from the head office and it was received at 94%, which include cost plus profit. So that is at invoice price. So we have to determine the cost of this, 88%. I think you remember those percentages. You remember these percentages. So the 188, and so those are the percentages still I'm using. So I have to look for 88, that is cost, so that I get the profit element, which is unrealized. So 88, so determining the cost first, so 146,040. So divide by 94. So I get the cost. So which means that I use the calculator to compute that. So if I take 146, so I'm getting 136,718. So I'm getting 136,718. So that I will take my 146,040 minus 136,718. So that you can see by the end of this, the unrealized profit was 93.22. So that one was on closing stock. Then there's another one on the goods on transit. Note 1, the goods of 3809. You remember that these goods were received by that branch after that branch has closed its books. So even if the branch received them, it never resold them, but it received them at a profit. So these goods first, they were being sold to the public, which we know they are at 100%. So which means that we need to get 94%, the way they were transferred to the branch. So if I take my 94 times 3809 times 100%, I think this one we got 28,960, hardly enough. Then I need to get the cost of that good. So 28,960 is equals to 94. What about the 88%? So I will take, that is 88 times 28,960 divided by 94. So I get the cost, so that I would subtract from the price at which they were transferred to get the unrealized profit which the branch never realized, because it never resold those goods. they were in stock, yes, they were received, but they were never resold. You can even see they say that they were received after the financial year has ended. So using my calculator, even this one we got early enough. So 27,112. So the difference between the two is all about 1848. So the total now, the total unrealized profit, I've said in short UP, unrealized profit, I will take the 9322, the one on closing stock plus the one on goods on transit, so that I will be able to get 11,170. So the 11,170, 11,170. So this is now the unrealized profit. So the unrealized profit to start with. So the 11,170. And that one will only be subtracted under the head office. Under the head office. Because obviously you know that it's the head office which sold these goods to the branch. But the branch never resold those goods. So which means that the profit of the head office is overstated by what the branch never realized, because it never resold those goods it has received from the head office. Then other expenses, I can see from the trial balance, we have something they call expenses. This is direct from the trial balance. So the 400,000 and the 40,000, you can check on the trial balance, head office and the branch. So this one you add direct. The one which are direct from the trial balance, they doesn't require any workings. So then remember that beside these items, the obsolete, spoiled, and the shortage, reducing our stock. At the same time, they are expenses to the entity. So we have to record them up there. And again, I have to record them as expenses down here. So we have the obsolete stock. So remember that this one was according to note 3 of the question. We have some spoiled. And finally, we have some shortage. Shortage was under the branch, 13,000. And this one we converted to cost. The 13,000 we converted to cost so that we record under combined, and we recorded 12,170. That one we have it already. Because we said this one is at 94. Because it was at invoice price from the head office to branch. So, but we need the cost in order to record at combined. And the cost is at 88. So we did that working. Then finally, there is depreciation of fixture. It's under the last additional information of the question. So you can see number 5, fixtures are to be depreciated at 20% per annum on straight line basis. And if you go to the question, you can see that fixtures is under the head office only. Fixtures in Nairobi, 160. So I have to take the 20% of the 160. 20% of the 160. And this one will affect the head office. Then I will record under combined. Then after that, we need to get the answers anyway. So this is just a computational thing. So if I do my first one, 438, 11,170, 400,000, 10,000, 5,000, 32,000. So I'm getting a net loss. So this one is a net profit stroke loss. So net profit or loss. So there's a loss of 2170. For the second is 90 minus 40,000 minus 13,000. There is a profit of 37,000. Then the last one, 516, 40, 10, 5,000, 12, 170, 32. So I'm getting here 16, 830. Then now remember that before we transfer branch profit to the head office, there was a bonus which was made to the manager of the branch. So note 4, they said, provision is made for a bonus to Mombasa branch manager at 10% of the net profit after, very major here, after the bonus. So bonus to Mombasa branch manager at 10% of the net profit after the bonus, So which means that this 37 is where we have to subtract it to get the bonus. So the bonus will be, so this 37 is at 110. So which means that I will take 10 divided by 110 times that, 37,000. Because they said net profit after the bonus, so at 10%. So the 37 is at 110%. So what about that 10%? So that this will be, this one is 10 divided by 110 times 37. This is, I'm getting 3360 what? 64. So 3364 is my answer there concerning bonus. So 3364 under combined. So net profit after the bonus now. So this one will be a loss, meant to be a loss. Then this one is 37,000 minus 3364. That would be, I'm getting 33,636. Then the last one, 16,830 minus 3364. That is 13,466. Then now we can do a transfer of the branch profit to the head office. Transfer branch profit to head office. So transfer branch profit. So this one will be subtracted here. It will be added under the head office. So this is where by now the branch is remitting the profit it made to the head office. So this one is 13,466. This one is nil. Then if I take 33,636 minus 21,770, I'm getting 13,466. So you can see they are equal for the head office and the combined. And that is how you are supposed to do the income statement. So let us move direct now to the second part of the question, which is the statement of financial position. So the second part is all about the statement of financial position. So Moshi Enterprises. So we do statement of financial position. So this one seems to be easy and doesn't require a lot of workings. So as and, so it was 31st March. As 31st March 2014. So we have the head office. We have the branch. So let me make it a bit. So head office. We have the branch. And we have the combined. So that is fine. So to start with, I have to start with non-current assets. I will be writing in initials. So I have to start with assets. So we have fixtures in Nairobi. So the fixtures in Nairobi. So remember that it was from the trial balance, you are given 160,000. So remember that there was a depreciation, which we already computed. So you take the 160,000 minus the depreciation. Remember that we did depreciation on that. We got 32, 20% on that. You can check note 5. They said 20%. So we got 32,000. So there's 32,000. So if I take 160 minus 32, that is 128. And it was on the head office only. Then you take under combined also. So the total there. After that, we said it's something concerning the current accounts which are prepared by the head office and the branch. We talked about the current accounts. So I said that. So this is the relevant notes, well prepared notes. So we said here, this account is maintained by the head office to record transactions between the head office and the branch. So this is the relevant account. That one I will prepare it later. So what I was mentioning is this NB. The balance in the branch current account represents head office investment in the branch. So head office investment in the branch. So we have to record that branch current account as an non-current asset because it was an investment in the branch. By who? The head office. That is why the head office maintains branch current account. At the same time, to act as an account which assists the head office to oversight the transactions of that branch. So we prepare branch current account. So that one I will come to do it later, and it will appear only under the head office. So I will skip a space there. It's going to be done later here. Then after that, we need to talk about current assets. So under the current assets, we talk about inventory. Remember that we talk about closing stock. And the closing stock, we did our working. We got this for 65, 146, 040, and 628, 830. The one we recorded there. So we did some workings. I think you remember that. So the first one will be 465. So this one is the closing stock, which we did early enough. Then we did the second one, we got 146, 040. The final one was 628, 830. I'm recording from the one we did. Then receivables. So trade receivables, just I will write in short, receivables. Debtors, that one is direct from the trial balance. Check in your trial balance. I can see in my equation there to 80 and 150,000 from the trial balance. So if you add the two, this one is direct for 30, because this one is 3, then 4. Then bank balance, again, direct from the trial balance for head office and the branch. So 158,000, 62,000. So if I take 158 plus 62 to 20,000, the total there. Then we have two things here to record, which I need to show you. So let me share the question. So remember for the trade receivables, we have recorded this and this. For the bank balance, we have recorded this and this. Next thing is all about goods in transit and cash in transit. That is what I have to record. Note 1, we have the goods in transit, which were 30,809, which were being sold to the public, being dispatched by the head office to Mombasa branch. They were received later. Even if they were dispatched on 28 March, they were received on 5th April. That is after the financial year has ended. So we need to record them as current assets. So you record them under the intended entity which was supposed to receive. So Mombasa branch is the one which was supposed to receive. So I have to record the 38,809 under the branch. But now I will not record at 3809 because this 3809 is the goods which were being sold to the public. And we know that 3809 is at 100%. So we have to convert it by taking 94% of that. So 100% is equals to 3809. What about 94%? So we got 28,960. We record under the branch. Goods in transit. So they were intended to be received by the branch, 28,960. I don't have to record under combined. Why? So you remember that when I was doing my closing stock of the combined, so when I was doing this, I included 27,112. The goods which were in transit. Remember, I converted them to 88%. So I don't have to record again under down here because already the 27,112 is inside the 628,830. So which is above here. Then the next thing I have to record is all about cash in transit. And it was under note 2, it was 50,000. It was heading to the head office. So this one I have to record under the head office and under the combined because it has not been adjusted in any way. Note 2. I think you remember that. So this Mombasa branch had sent cash amounting 50,000 to head office. So cash was received until 6th April. So that is what I've recorded. It was on transit. Then after that, we are done with assets. So I will say total assets. Then after the total assets, I have to record the capital and liabilities. So capital and liabilities. So for capital, it was given direct under the trial balance and it was only under the head office, 1 million. So we take it under combined. Then we have to add the net profit. So the net profit is the one which we got when we did our income statement, the final one here, after we transferred this profit to the head office. Finally, we got 13,466. Then we said now, the branch maintains head office current account. Current account. So of which it's supposed to be recorded there under the branch. Why? Again, this one is well explained on the notes I started with. So remember that the head office is maintained by the head office current account. Head office current account is maintained by the branch to record the transactions between the branch and the head office. NB. So you can see this is the account. We will prepare it later. So this is the account. So we have said the balance in the head office current account represents operating capital to the branch, and therefore should shown therefore shown as equity, therefore shown as equity component in the books of the branch, shown as equity because it's operating capital to the branch. So that is why I'm recording it under this point, and it would be done later. After that, we move to non-current liability, but there was none. There was no current liability, not current, but non-current. There was no non-current liability. Then current is there. Current liability is present because we have some trade payables. So we have the payables. I will write in short. You know, it's trade payables. It's only that I've written payables. So it is 400,000 from the trial balance, direct, and the 40,000. So you get this is 40,000. Then finally you record the bonus which was supposed to be paid to the Mombasa branch manager, the bonus payable. Remember we did this and we got the bonus was 10%, and we got 33.64. And that is fine. Up to that point, I think I'm done. So total, equity and liabilities. So in order now to balance these statements, it's very easy. I will start from combined, from the column of combined. So you can see here, combined, there's nothing which is missing. So I can look for this total assets. I will take 128, 628, 830 plus 430,000 plus 220,000 plus 50,000. So that one is giving me 1456, 830. Then what about down there? 1 million plus 13,466 plus 440,000 plus 3364. I'm getting the same. 1456, 830. Then what about the branch column? So for this one, I can get total assets. So I take, so there's nothing here. So the 146,040, 150,000, 62,000, 28,960. I'm getting 387,000. So this one, remember that assets and liabilities are supposed to be equal. So this is the one which is supposed to be down here. So if I take this minus the 2, remember I will get this. So I take 387,000 minus 40,000 minus 3364. So my head of his current account will be 34, 36, 36. So it's not a must you do the account itself, but you can do it that way. So after getting this, it's supposed to be down here. Then add these two minus from the total, you get this. Then what you need to know is that I said the two current accounts are supposed to be equal to each other. So the head office current account, which is prepared by the branch, and the branch current account maintained by the head office are supposed to be equal. So which means that this one is supposed to be 34, 36, that is 343, 636. But the only thing I will subtract here, so I will take 343, 636 minus the unit, the unrealized profit of 11,170, because there was some goods which were being sold by the head office to the branch, and the branch never sold all of them. So which means that the profit of the head office was overstated. And remember that the branch current account contain it's like an oversight. So we have to reduce even that profit. So these accounts are supposed to be the same, but under now the branch current account net and realized the profit. And that one was on the goods, which remained in the stock of the branch, the 11,170. I think we did that You remember, I can display, you see where we got that. We did this, eh? That is the relevant thing we did. On the closing stock and the goods on transit. And so if I take my calc 34, that is 343,636 minus 11,170, I'm getting 332,466. So let us add. So now adding with my calculator, I will take 128,000 plus 332,466. Third one I'm getting here is 466. Then 465 to 80, 158 and 50. I'm getting 1413, 466. Then the other one, 1 million plus 13, 466 plus 400,000. I'm getting 1413, 466. So you can see my question is balancing. So this one is okay with this. This one is okay with this. And this one is fine with that. That one. So that is how you are supposed to do the statement of financial position. Then finally, what if, for example, now the examiner asked you to do the two accounts, the current accounts? What if you are asked to do them? So under books of head office, we have the books of head office. Remember that under the books of the head office, we prepare the branch current account. And under the books of the branch, the branch will prepare head office. Will prepare head office current account. So we have to start with the relevant balances as given in the question. Then we adjust with some of the items there, like profit and goods sent to branch and cash in transit. That is the only thing which is there. So for the books of the head office, in the books of the head office, it prepares branch current account. So you can see the head office current account. It's prepared by the branch, which is on the far end. Then under the branch office current account, the branch office current account, this 360 is under the column of the head office. So the 360, and it's on the debit side. So I will debit that. The way this, so there's debit, credit, debit, credit. So it's on the debit and under the column of the head office. So branch office current account. So the 360. Then for the branch, it maintains head office current account. And you can see the branch maintains head office current account. And the head office current account, you can see here, it's on the far end under the column of the branch, and it's on the credit side. So which means that I will brought down by crediting. So 381,040. So I will record here 381,040. Balance brought down. Then what you are supposed to record here is the profit. And at the same here, you add the pro. So the profit which was being transferred by the branch to head office. So this was the profit we got from the income statement. So 33,636. So 33,636 from the income statement. Then note 1, you remember that there was some goods in transit, and these goods were going to the branch. And these goods were going to the branch. So since they were going to the branch, remember that the relevant accounts they would affect is all about debit inventory account, because they will be received under the branch. The goods, remember, they were 3809, but this one at 100%, so we need to get 94. And they were being dispatched by the head office to the branch, so they will increase the stock, that is debit stock, then credit. So I will debit the stock, then credit this one, credit the branch, because they were heading to the branch, which branch maintains head office current account. So goods in transit. So which means that I have determined that 94%, because there were goods being sold to the public at 100%, and there were 30,809. The same with cash in transit. So the cash in transit, according to note 2. So remember that these goods were going to the head office. So the head office would debit cash, then credit this account, the current account, and we know that the head office maintains branch current account. So cash in transit would be credited, then debit cash. So it was 50,000. So the balancing figures of these accounts are supposed to be the same and opposite to each other. They are supposed to be the same. And you will realize that they are supposed to be the same, the one we recorded under the statement of financial position, under the two accounts. So if I do the first one, my balance carried down here, I'm getting is 34, that is 343, 636. The same one with this. So 343, 636, 636. So you can see they are the same and they are opposite to each other. And they are the same with the one we recorded here. 343, 636, 343, 636. It's only under the branch current account we have to reduce with the net profit, which was unrealized. That is net profit unrealized. That is how you were supposed to do this question generally. And that was what is required by the examiner to do when you are doing a question for local independent, for the local independent branches. Local independent branches. So, and that is the end of the question. So if you are not understanding the areas where you are not understanding, I have formed a WhatsApp group for this YouTube. So request to be added. So just text me, write a message to me through 0728 760 546. Just say that you are from YouTube and you will be like to be added to the relevant WhatsApp group for these units. So the work I'm doing. So that in those groups, that WhatsApp group is whereby you will be asking questions of the same. So my number is 0728 760 546. So at the same time, anyway, if you check in my social media platforms at Edwin OCHOI, that is at Facebook, Edwin OCHOI, then at the same time, even at Instagram. So you can ask me questions from any perspective. Maybe you text to be added to the WhatsApp group. Just you can write a message to me. You can write a message to me through various platforms, Instagram and Facebook. At the same time, never forget to subscribe. So before we end the session for today, I would like to introduce foreign independent branches so that next time we do a question. So when we are talking about now foreign independent branches, So this is whereby you find that before you prepare the combined financial statements, the head office must translate the operations of the foreign branch to the reporting currency of the head office. So these are according to International Accounting Standards 21. So whereby now this standard has provided us with two methods for translation of operations of a foreign branch. So we have the presentation currency method and the functional currency method. So for the presentation, it's suitable for translating operations of autonomous entities. That is independent entities. Then for functional currency method, suitable for translating non-autonomous entities, which we say is dependent entities. So you can see that we have said most of the branches are independent. So which means that since we have talked about two methods, presentation and functional currency method, presentation currency method translates operations of independent entities, and that is the one which would be recommended, because now the branch which I'm dealing with, the foreign, will be independent. So the functional will not be used. So we have various items to use. So we have income statements, items, incomes and expenses. So those ones you translate using average rate. Assets and liabilities use closing rate. Capital and reserves, historical rate. Depreciation. So depreciation use rate used to translate the respective assets. Current accounts use the actual. Remittance use the actual. So that is according to presentation. So what if it's a functional currency method? Maybe if it was dependent entities. Incomes and expenses use average. So that is now for functional. Current assets and current liabilities, closing rate. Non-current assets and non-current liabilities, historical rate. Capital and reserves, historical rate. Depreciation rate used for the respective assets. Current accounts, actual, then remittance, actual. When I talk about closing rate, I say that it's the rate which was prevailing on the date when the statement of financial position was to be prepared. Then the historical rate is the rate which was prevailing on the date when the foreign subsidiary was acquired. So we can make some short notes, then we call it a day. So I am talking about foreign independent branches. So the foreign independent branches. So foreign independent branches. So when we talk about foreign independent branches, I've said before preparing the combined financial statements, the head office must translate the operations of the foreign branch to the reporting currency of the head office. So according now to IAS 21, that is IAS 21, International Accounting Standards 21, has provided two methods for translating the operations of foreign branch. So we have the first one being presentation. So we call it presentation currency method. So the presentation currency method, this one is suitable for translating operations of autonomous in nature. So autonomous, when we say autonomous entities, these are independent. Independent. Then we have the functional currency method. So when we talk about functional, is suitable for translating non-autonomous entities. So these are non-autonomous, are about dependent. So on this scenario, remember that we are dealing with foreign independent branches. So the one which is suitable is this one, presentation, because suitable for translating operations of autonomous entities. And we can see that the autonomous entities are independent. So that is the one we need to know how to translate its operations, its items. So now to translate the items, I would be writing here now. So the presentation, I will start with the presentation method. So the presentation currency method. So for the presentation currency method, I have the item and we have the rate applicable. So which means that, for example, if you have incomes and expenses, so these are some of the income statement items. So this one use the average rate. So you will be given the average rate in the question. Then after that, you have the assets and liabilities. So for the assets and liabilities, so this one use the closing rate. So for the average, they will just state direct, this is the average. But for the closing, they will give you a certain date. And we say that the closing rate is the rate which was prevailing on the date when statement of financial positions was to be prepared. Rate which was prevailing on the date when statement of financial positions are to be prepared. That is the closing rate. Capital and reserves. So for the capital and reserves, use the historical rate. Then after that, we have depreciation. So depreciation, this one now you use the rate used to translate the respective asset. And most assets you will find that we have used the closing. So rate used to translate the respective asset. Rate used to translate respective asset. So the way you translate the respective asset which is depreciated, the relevant depreciation you translate at the same rate. Rate used to translate the respective asset. Then finally, second but not least, not finally, so current accounts. So current accounts, you go with the actual. I will show you what actual means when I would be doing the now practically. Then we have remittance. Remittance, again, you go with the actual. So that is how you translate. So for example, now what if you deal with functional, but functional will never be used because you can see I'm dealing with foreign independent. Anyway, I can mention what if you are using functional. What if you are using functional? So now for the functional currency method, the items and rate applicable. So the same here, if you are using this method, incomes and expenses. So for the incomes and expenses, use the average. Then for the current asset and current liabilities, you use the closing rate. Then for the non-current liabilities, non-current assets and non-current liabilities, so non-current assets and non-current liabilities. Use the historical. Use the historical rate. Then we have capital and reserves. So we have historical. Depreciation, obvious the rate used for the respective asset. Rate used for the respective asset. Then we have current accounts. So this is the head office and the branch current account, you go with the actual. Then for the remittance, you go with the actual. Then I say that NB, so the closing rate, that is what you need to understand what it means. And historical, closing and historical rate. Because the others I will just pick direct. So for the closing rate is as at the date of the preparation of the statement of financial position. So the date when the statement of financial positions are to be prepared. So as at that date, the rate which you would be given is the one which you use. Then for historical is the rate which was prevailing on the date when foreign branch was acquired. So this one is when the foreign branch was acquired as at that date, which would be given again. So that is what you need to understand for now concerning foreign independent branches. But between the two methods, I have said, which is a presentation currency method and functional currency method, for foreign independent branches, you use this presentation currency method. That is the one which is used to translate independent branches, because those foreign branches will be independent. So that is the relevant rate to use for every item. So I will be doing a question of 2012 in our next video for financial reporting. And that question of 2012 is the copy paste, which they pasted. They copy pasted for the 2018. So once I am done with the 2012 question, it means that it's the one which was tested in 2018. It's the same with topics like contracts and the other small topics. So I can display the question. So let me share the question. So this is the question for 2012. So it starts at this point where they say Erigon Limited manufacturing concern exports some of the products through an overseas branch whose currency is the milli. The reporting currency of Erigon is Kenyan shillings. The overseas branch carries out the final assembly for the products before the goods are sold to customers. So the trial balance of the head office and the overseas branch is given there, you can see. So you can see that Erigon is a manufacturing concern. It exports some of the products through the overseas branch, of which the overseas branch, its currency is milli. The reporting currency is where the parent is Kenyan shilling. So that is where that is the head office, not the parent. Let me use the word they have used, head office. the currency of the head office is the reporting currency, so which is Kenyan shillings. So when I will be doing my question, first I have to translate the operations of overseas branch milli to Kenyan shillings. So you are told additional information, admin expenses for head office and the overseas branch include depreciation of 10% on the cost of machinery. On 28 March 2012, branch remitted 40,000 milli, which was received by the head office on 2nd April 2012. And you can see that our financial year ends 31st March. So they were never received by the end of the year. They were received 2nd April. That is some 2 days after the end of the financial year. So this cash, which was limited, was on transit by the end of the year. So that is cash in transit. There's a provision given there of 750,000. Then note 4, during the month of February, a branch customer in error paid the head office for goods supplied by the overseas branch. The amount due was 800,000 milli, which realized in Kenyan shillings 90,000. The amount was correctly accounted for by the head office. No entries had been made in the branch books to reflect the transaction. We will make that correction. Then you are given the rates. I said for the average, you can see it would be given direct. Then for the others, you need to determine which is the closing, which is the historical. And the examiner has given you the rate on purchase of building and machinery. So when you will be translating the transactions of building or machinery, use that relevant rate. So they need branch, translated trial balance, head office, branch income statements, and combined head office and branch statement of financial position. So that is a question for another day. May 2012, it was a copy paste, which they tested again the other day, 2018. If you can check. To be more specific, it was on 2018. That is, even not 2018, it was on 2019, by the way. So the same question was on 2019, May 2019 question 5, and it was 20 marks. They call it Baraka Limited. They call it Baraka Limited. So you can have a nice time. We meet when I will be doing the next one. And at the same time, do the necessary, continue with your revision, and all the best in your exams. But this is not the end. We have again time to do more. So my name is CP OCHOI. Support my content, share to your other guys, finance guys, accounting guys, and many more guys. I would just appreciate. Nice time.